More than $300 billion flowed into fixed income ETFs in 2023, a record there. Our next guest firm accounted for nearly half of that. So where is the opportunity in fixed income markets now as investors step out of cash? For answers, we're going to bring in Steve Laipply, BlackRock Global Co-Head of iShares Fixed Income ETFs. Steve, it is good to see you. So maybe start here, Steve. You know, as you kind of look across the universe of bond ETFs as we start the year here, Steve, where do you see the opportunity?
Well, Josh and Julie, thanks so much for having me on today. We see tremendous opportunity. So last year, when we had a very powerful tightening cycle, we had one of the most challenging bond markets in many, many years. But the upside of that was to be able to get yields at levels that you have not seen since pre-crisis. And so it was a very volatile year last year. But in the end, interestingly enough, the ag, as a rough proxy for the broad bond market, returned over 5.5%. So where we are today is we still see this opportunity persisting. So yields are above 4%. It used to be that you would have to go all the way down into high yield to get a 4 to 5% yield before COVID. And now you can get that at the front end of the yield curve. That being said, we do think it is time to step out of cash. We think it's time for investors to up their allocation to fixed income. No matter what, we think that it's the timing of this to be able to lock in income at these levels and prepare for the Fed to start cutting rates and potentially for a softening of the economy. I think a lot of investors are still circling around this idea of a soft landing. But be that as it may, it's time to start locking in these yields and upping your allocation to fixed income to balance your portfolio.
And Steve, just to put a fine point on this, like if I can go out and get a CD for 5%, what's wrong with that at this point?
Oh, that still works. But the Fed at some point, if you do believe what the market consensus is and the way the futures are pricing, they will start cutting rates this year. Big debate over whether that starts in March or not, but it does look that they will start cutting rates, and so it is a good time to lock in these yields now. You can debate whether them cutting rates will drive all yields down or not, but yields at 4% long term are still very, very attractive relative to where we were before. There are a lot of ways to do that. You can allocate to the broad market through something like the AGG or the Universal IUSB, or if you do want a more active approach, you can allocate to something like BINC, our flexible income fund, or BlackRock Total Return, BRTR. So what we do know is investors have been cautious during this tightening cycle. They are pretty much significantly underallocated to fixed income. So we think it's time for them to start moving out of cash and topping off that allocation.
And Steve, I'm just interested, when you look at the flows into bond ETFs right now, do we have any line of sight into where that's coming from, Steve? Is it kind of your traditional, fixed income investors? Is it institutions?
Yeah, so it's all of the above. What we did see, and I do think this started back in 2020 with the onset of the volatility when the pandemic set in, we did start seeing very large institutional allocations into bond ETFs. That has persisted. We see 10 out of 10 of the largest global asset managers have now used bond ETFs in their strategies. 8 out of the 10, or I believe it's now 9 out of the 10 largest insurance companies have used bond ETFs as well. And so we've seen this very significant institutional adoption and using fixed income ETFs, as tools for actually generating excess return, in addition to just earning income. Traditional retail investors have also really started discovering the utility of this tool, which explains why you've seen so much interest in active fixed income ETFs. So our investors have been telling us that they want to see their most popular active fixed income strategies brought to them in the ETF wrapper. So that is a very powerful trend right now as well.
And Steve, do you think that if what the Fed does differs significantly from market expectations this year, that will cause a hit to some of these flows or a change to some of these flows? If, for example, we get fewer rate cuts this year or they start much later?
Well, yeah, mathematically, I think the market has priced in, a little over 5 cuts. That March cut is now less than 50-50. But if you look further out, the market is pricing in for around 5 cuts. And so, sure, if for example, you start getting inflation data in particular, that starts running much hotter than expected, and you could start seeing some of that priced out. Yields will rise, and maybe some of that will flow down. That being said, if you look at 2022 and 2023, you still saw very significant flows into fixed income ETFs. And again, I think that's driven just by this idea that it's very hard to call the top in rates. It's going to be volatile, so it's better just to get allocated, even despite the volatility. Last year was a great example. Like I said, we ended up returning over 5.5% in the aggregate, despite all the volatility throughout the course of the year.
Steve, thanks so much for joining today. As always, really appreciate your time and insight.
Thanks, Josh and Julie. Thanks for having us.